What's my credit score? How much money do I have in the bank? Can I even handle owning a home on my own? These and other similar questions are common amongst first-time home buyers, and rightfully so. Assessing your readiness to be a homeowner for the first time is a big deal, and today we'll help you answer these and other questions so you'll know without a doubt that you're ready to take the plunge. Welcome to the show that dives into common real estate topics and trends fit for both the beginner and seasoned pro alike. My name is Eric Coleman, owner and team leader of the PRC Properties Group, and your host here at the PRC PG podcast. In this first episode of our 5-part series titled First Time Homebuyer's Guide, we explore the 7 financial and emotional considerations that are involved when determining your readiness to buy your first home. So, without further ado, let's dive in. I think it's fair to say that one of the first things that come to mind when someone is considering buying a home for the very first time is, can I qualify for a loan, and how much money do I need to have in the bank to pull it off? Both of these are extremely fair and accurate questions for anyone to ask, so let's break them down. First, what does it take to qualify for a loan? While there are several factors that a lender will consider when considering your approval, there are 3 factors that play the biggest role: credit score, steady employment and income history, and an acceptable debt-to-income ratio. While you can use apps like Credit Karma and certain banking apps to give you a running credit score at a moment's notice, it's important to remember that these scores are not what's going to come up as your FICO score when a lender runs your credit. So, what kind of score do you need to qualify? Well, technically, people with a FICO score of 580 can qualify for an FHA loan. And we'll get into the different types of loans here in just a bit. However, each lending institution has the ability to make their qualification criteria more strict than this. And quite frankly, most of them do. So in my experience, to give you the best chance at qualifying for a mortgage, you need to be at about a 630 or better. Now, there are exceptions to this, of course, and each loan type has their own specific qualifications, but that's just what I've seen over the years. So now that you know what you're dealing with regarding your credit score, let's talk about employment and income history. Now, generally speaking, a lender wants you to be able to show at least 60 days worth of employment income as what we call a W-9 employee, or rather someone who's employed full-time by their current employer and not on a temporary assignment, otherwise known as an independent contractor. Don't worry, if this is you, we'll get to you in just a second, I promise. A longer work history is always better, but as long as you can show at least 60 days and your HR department can verify your employment status, stated income, and they aren't preparing to fire you for any reason, you're usually good to go. Now, if you happen to be in the middle of relocating and you're moving for a new job, as long as your new job is in the same field, you can use your previous employment history as a means to qualify. All they'll need is your offer letter from your new employer giving a start date, a job title, and what your new salary will be. Now, if you happen to be an independent contractor like, real estate agent like me, then the rules are a bit different. Instead of 60 days worth of employment and income history, the lender is going to want at least 24 months.
What did you say?
I know, right? Talk about a difference. It almost seems unfair, and quite frankly, it really does seem unfair. But while it's easy for us 1099 folks to get upset with the banks over this, I suppose you can't really blame them since, we are 100% in control of how much money we make or don't make. The banks want to see a nice track record of steady income before they make a business deal with you that's going to last for anywhere between, 15 and 30 years, right? So business minds, folks, that's what we're shooting for there. But now that you know what your credit needs to be, to look like, and what sort of employment and income history the banks are looking for, let's talk about your debt to income ratio. Now, this is a big one that gets overlooked by a lot of people. Strictly speaking, if the bank feels that your debt each month is more than it should be, based on the amount of money you bring in, then they won't feel that you're a good risk, despite your credit score, and will not approve the loan. Now, I'm not going to go into too much detail here because, to be quite honest, I'm not 100% positive on the numbers, but the easiest way to say it is that you want your debt to income ratio to be as low as possible. Now, the requirements do vary by the type of loan product that you're trying to qualify for, but just know that none of them are going to let you get, too out of control. So, as a quick teaser, we have another series coming up in the next few weeks titled Real Estate Financing and Credit, where I'll be joined by a loan officer that I've had the pleasure of working with for a while now as my guest for the entire series. And we'll be going much deeper into the entire loan process. So do yourself a favor and subscribe and or follow the show depending on the platform you're using so you won't miss an episode. And since I'm in the middle of a shameless plug, consider leaving us a review, as we'd love to hear your feedback. All right, moving on. Now that you have a general idea of what it takes to qualify for a mortgage loan, let's talk about how much money you're going to need to have to make it to the finish line. Okay, so let's pretend for a moment that you happen to get connected with me in some way to use as your real estate agent. And I asked you this question: how much money do you have saved up for a down payment? What would your response be? If I were a betting man, I would posit that the majority of you listening would say, we have the whole 20% saved up. Why, you ask? Well, it's been a commonly held belief amongst the majority of home buyers that 20% down is what a bank will require in order for you to secure a home loan. At least it's been that way for as long as I can remember anyway. Now, after hearing that, I'm sure many of you listening are thinking, well, that does it for me. I'll need quite a bit more time to save up that money. Well, thanks for the podcast, Eric. We'll see you in a few years. Well, I have great news. As a first-time home buyer, you only need to come up with 3 or 3.5% down. That's right, 3 or 3.5% down. No one has told you this before, I'm guessing. And if they have, then you have a good one and I wouldn't let them go. So if you're a first-time home buyer and you qualify for a loan in every other way, you only need 3% down for a conventional loan and 3.5% down for an FHA loan. And if you're using a VA or USDA loan, you can get into your new home for 0% down. Okay, I'm getting a bit ahead of myself here, but this stuff gets me pretty excited considering most people don't know this information. So is that it then? 3 or 3.5% down and I'm done? I can buy a house? Well, no, because we're not done yet with the costs of homeownership. The last financial item to consider is how much cash you have on hand in addition to your down payment to cover your upfront and closing costs. So let me try and break it down. In my experience, 4% of the sales price of the home is a good number to use to estimate your total closing cost. Now, this can vary slightly depending on the title company used, etc., but it served me well as being pretty accurate during my time in this business. In addition to the 4%, however, you need to budget for these two items at a minimum: a third-party home inspection and the lender's appraisal fee. These two items can run, in Texas anyway, anywhere between $1,000 and $2,000 combined, and will be upfront costs collected between the first 1 to 2 weeks of being under contract on your new home. So just to put some numbers to it, if you bought a $300,000 house, you would need anywhere from $9,000 to $10,500 for a down payment, and you'll need approximately $12,000 to $14,000 for closing costs and out-of-pocket expenses. I mean, nobody said buying a house was cheap, right? So what sort of loan should you go for then? Well, that's really between you and your lender, as each loan product has their own features and benefits that might suit your particular situation. Now, I kind of let the cat out of the bag on this one earlier as to the down payment benefits, but we'll be diving into these in greater detail in our upcoming series that I mentioned earlier. So, I mean, wow, that's a lot, right? Yeah, it really is. But now that you have a pretty decent grasp on what's needed to assess your financial readiness to buy a home, let's talk about the part that most people forget about: the emotions that are involved in buying your first home. Now, buying and selling a home isn't as much of a business transaction as it is an emotional one. Now, I've made that exact statement to countless clients over the years, and it still holds just as true today as it did when I wrote my very first contract for my very first buyer. Since this series is focused on buyers, I'll stay on that side of the aisle, but just know that the seller's emotions can have just as much of an impact on your home buying journey as your own. But we'll save that for another episode. So the first emotion that comes to mind is that of just general excitement, right? I mean, who isn't excited at the prospect of buying their first home? After all, it's the American dream. It stands for freedom, independence, possibly something of great value to pass on to your loved ones after you're gone. If you're coming from a situation where you're currently renting a place, it means doing what you want to your house, both inside and out, without needing to ask for permission, or worse, being told no. That also means that no one will just arbitrarily sell it out from underneath you and tell you that you have 30 days to get out and find a new place when you're only 3 months into your 1-year lease. I can't tell you how many clients I've helped buy their first home that were in that exact situation. Now, these are all really great things to be excited about, but all of this comes with a bit of a cost as well. And that tends to dampen at least a portion of that excitement for most people. And that's the fact that you're now financially responsible for everything that happens inside and outside of that house. No more calling a landlord if something breaks and not having to worry about the cost of the repairs. No more letting the landlord know that they received an HOA violation for something that isn't covered as a you responsibility in your lease agreement. And finally, if you're living in an apartment, condo, or in a home that has this included as part of your lease, no more relying on someone else to be responsible for the yard work and general landscaping. And let me tell you, if you're listening to this not too long after it was published and you are in Texas, then you know that yard work is not something you want to be doing right now with this crazy heat wave we've had going on. But whether you want to or not, if you own your own home, you're either faced with getting out there and taking care of it yourself or find someone to pay that will come do it for you. By the way, not a bad option if you can work it into your budget. And if all of that wasn't enough, there's one final emotional battle that will need to be fought, and that's the emotional ups and downs of the actual buying process itself. Now, depending on the market, it's been my experience that a lot of people consider the process of finding a home and getting their offer accepted to be the most stressful part. That is until they begin the wonderful journey from contract to close. Scheduling inspections, negotiating repairs, and worst of all, navigating the loan underwriting process generally holds the title of being the most stressful and emotional part of the buying process. I've caught some flack from colleagues on this next part, but when I counsel my buyer clients on this part of the process, I normally describe it like this, and forgive me in advance, okay? Imagine that you're standing naked in the middle of a room full of strangers and can do nothing except stand there while each of them all at once walk up and inspect every little inch of you in the most uncomfortable way you can imagine. And just when you think it's over, they come back for more. Incredibly invasive is the only way I can describe this part of the process. They're going to ask you for all sorts of information and documentation, and even after you've given it to them, they'll come back and ask for it again, and possibly again. And when you tell them that you've already given it to them, they'll say, yeah, that's great. Send it to us again anyway. It really is remarkably unbelievable. There is good news, though. After all of what I'm sure a lot of you listening would call good old-fashioned bashing of the lending industry, I feel it's important to point out that the reason the process is as thorough as it is so we won't fall back into the same situation that resulted in the housing crisis of 2008. It's because of these new laws, policies, and procedures that are in place that we didn't see a housing crash over the last year and a half once the market slowed down. And there's more good news. Having the right team around you, your agent, your title company, and a great lender can help take a ton of stress off of you during this part of the process, which is why I always say who you're in business with matters. So, which of these considerations concern you the most? Are you ready to take the next step to homeownership? Let us know your thoughts in the comments section. Or if you're listening to us on your favorite podcast streaming service, consider leaving us a review. We'd love to know what you think. Be sure to join us next time as we talk about mortgage pre-approval and loan options for first-time homebuyers. Till then, stay safe and have a blessed week.